Hey there. Welcome to the final bar. Today, my guest is Katie Stockton from Fairlead Strategies. We're going to talk about a couple asset classes top of mind for many. We're going to look a little bit at cryptocurrencies, but also hard assets, gold, and sort of the constructive pattern that we've seen there. Speaking of constructive patterns, stocks were in. The growth trade back alive and well today with the S&P up 1%, but the NASDAQ almost doubling that. Is this the end of value and the beginning of growth? I don't know about that, but let's look at some of the charts, especially on the growth side, really emerging in positions of strength. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets themselves provide. One of my mentors, Ralph Ekampora, always said, if he had one thing to understand the S&P 500, it would be a chart of the S&P 500. Forget about all the noise, forget about all the speculation, forget about all the inputs, just focus on price and look at what markets are doing. And overall, on a day like today, where you're seeing renewed strength from growth names and relative weakness in the value space, just reminds me to focus, not to anticipate what could happen based on some crazy narrative, but to focus on the message of the markets themselves. Overall, we've been in rotation mode, we've been in consolidation mode. As we talked about yesterday, I think the chart of Apple represents sort of the market environment. We're range bound, we're sort of consolidating. There are moments when things look good and moments when things look bad, but in the end, it's all about defining your risk, defining those lines in the sand at which you review positions and review your investment thesis. We have a great guest today, Katie Stockton, joining us from Fairlead Strategies. We have some other wonderful guests coming up next week. On Tuesday, the 25th, we have Louis Yanis from WealthNet Investments. On Wednesday, the 26th, Javed Mirza from Canaccord Genuity up in Toronto. Also, two really cool events coming up next week on StockCharts TV. All week, it is a series called Chart School Idea Generation. We are bringing the Chart School part of our website onto StockCharts TV. This is the educational platform that we provide to all of our users. We're going to focus this next week on idea generation. 5 different experts showing how they use the StockCharts scan engine to break down the equity universe and ETFs and focus on actionable ideas. It's going to be 5 days of new ways to think about screening for ideas, and I hope you can join us for that. Also on Thursday, the 27th, our next episode of The Pitch. This is our stock picking showdown where we have 3 guests. I'll be moderating a panel with Aaron Swenlin from Decision Point, Mary Ellen McGonigal from Men Investment Edge, and also Danielle Shea from Simpler Trading, all bringing 5 ideas with them. We'll discuss them as a group, debate the strengths and weaknesses, and see what we can come up with. That's coming up on the 27th. Let's get to our market recap. So, certainly the last 2 days, if you look at the 2 days of the S&P, it's been certainly chipping away on the upside. Overall, we're still off of all-time highs, but not by much. Days like today push us further and further back to the upside. And overall, you sort of have this consolidation pattern. However, as we've talked about in a number of examples recently, there are plenty of stocks that are in really good constructive patterns. I was looking earlier, by the way, at the chart of Facebook, and I'm struck by just the general constructive pattern of this. There have been times when the FANG stocks looked really questionable, and especially right here, sort of the beginning of the year, you had Facebook and pretty much all of the FANG stocks in a consolidation phase. Some of them testing swing lows. You had Facebook testing its 200-day. Look at how much that picture has changed. You've now broken above the September high and retested it from above a couple times. We're staying above an ascending 50-day moving average. That's a constructive chart. In general, all else being equal, I tend to assume that is in an uptrend and is most likely to go higher until proven otherwise. Keeps making higher highs and higher lows. So leaning into charts like that are in constructive patterns makes sense to me. Days like today with the strength and growth is making charts like Facebook look stronger than they have been recently. And the stock's been outperforming for the last 8 to 10 weeks. So overall, a constructive pattern. And those are the types of charts that I'd love to focus on and identify, and stay away from some of the ones that are struggling to outperform. The Nasdaq, as I mentioned, up about 2%. Looking at the Nasdaq 100 versus the S&P's 1%. Noticeably, mid caps and small caps underperform. So this is led by the sort of the large mega cap trade pushing things higher. It's worth noting, by the way, the third strongest sector, real estate. So again, this is not a pure offense over defense. It's sort of a mixed bag of things, but real estate, a relatively high dividend paying sector, number 3. The VIX actually, by the way, back below 21 after heading up into the low mid 20s in recent days. 10-year yields continuing to go down, and down around 163 on the 10-year. The lack of follow through to the upside on interest rates is certainly one of the things fueling a day like today when growth is working just fine. The TLT, our proxy for bond prices, up 0.8%, and the dollar index down about 0.5% using the UUP. Commodities mixed, overall sort of net down, and energy was the weakest of the 11 sectors, although not down by much. Gold and silver, by the way, the precious metals trade holding up there just fine, and continuing to push overall higher. Yesterday, we looked at cryptocurrencies, all bright red, looking at this negative trend here. Today, we get the reversal higher, and you see how they've all recovered. Now, again, anyone will tell you a 20 to 30% loss followed by a 10 to 20% gain. You're still pretty far underwater from where you started, although this is a decent recovery. It'll be very interesting. We talked about the chart of Bitcoin in the last couple of days in a little more detail, but the real question is, have we seen that bottom? Bitcoin going all the way down to just about 30,000 after coming from the upper 40s about a day earlier. So the question is, was that the bottom? Is this just a recovery bounce off of those lows? Perhaps talking with my guest Katie Stockton today, we can hopefully put some clarity behind some of those movements. Now let's look at the S&P 500. Look at the broad chart again. This is why, while things have looked challenged, while certain stocks are looking at questionable returns, the question now is, what is the overall market doing? And I would say, overall, holding in there just fine. You've seen some initial short-term breakdowns, and we talked a couple of weeks ago about 4120, the importance of that level, which is the pink dotted line that you see. When we broke below that about a week and a half ago, that certainly signaled some internal weakness, some potential for further downside. And again, in any sort of pullback like that, the question always is, what's the line in the sand? What's the level at which you decide that this is certainly turning into being something more deeper, more destructive, with higher potential for capital loss? What we talked about was the 50-day moving average and the trend line support taking the October low and the March low. And as you can see this week, as with last week, we've bounced off that level beautifully. So far, we've registered about a 4.5% give back, which is very, very similar in a lot of ways to what we saw at the end of January, right? You had this bearish divergence of higher highs in price. We saw the same thing there in April. You saw the negative momentum divergence, very similar to what we saw there as well. And we've pulled back about the same amount right down to the 50-day moving average. Now, the real difference here so far, or what we've seen differently, is in January, you turned left very quickly and made new highs within about a week and a half. So far, a week and a half later, we're sort of consolidating. We're chopping around this sort of middle range, which is why it feels a little more like what we saw end of February. Or even, dare I say it, sort of September of last year, which was the beginning of, a deeper correction, not really as much in price, but more in time. This is more of a longer duration, consolidation phase before we broke out of that pattern to the upside. I'm not sure which of those is gonna play out necessarily, but I would say we're right at that line of support. And I think for a lot of stocks, you're right at that point where you could see a meaningful bounce from here, and you have to look for some signals, a higher low, signs of accumulation, breaking above a new swing high. A day like today, pushing back toward the high from last week is certainly an encouraging movement. But the question is, are we able to push above these levels? If and when the S&P breaks that trend line, if and when Apple breaks below that trend line support, the 50-day moving average. Again, my concern with looking at the overall market conditions, and let's look at the chart of Apple here. We talked a little bit about this yesterday. My concern is where this would resolve, and we're very close to the point where this would resolve to the downside. And if you would see the S&P break its 50-day and break that trend line, if you would see Apple break below its trend line support. All of a sudden, these charts transition very quickly from looking pretty stable to very unstable. And I think you could see a flood for the exits in a very dramatic fashion, because we're right at those levels of support where you could argue we're in a buy in the dips mentality. If people start to see that buying on the dips is not working, that we're going to have a correction deeper than 5%, I think there's a feedback loop in there. The further we break down, the further people recognize that that's not going to be the case. And again, the selling pressure, the lack of buying power continues to fuel that downward trend. So that is the scenario. And that's why looking at this chart of Apple, I think, is really key at the 200-day moving average, at the trend line support as well. Looking at the S&P to see if it's going to hold there or not is pretty interesting. Let's finish off our recap here looking at the fixed income market. So, the real key for bond prices is that they've stopped going down, right? There's this whole downtrend in the TLT. If you flip that over, that's the chart of the 10-year yield, just continue to go higher up to 160, 170s, and now has sort of come stable, pulled back to around 1.5% on the 10-year, and now bouncing back in that range. That's this period here where the TLT bounced up to around 140 resistance and now has pulled back. And the question now is, which way wins? Do you see a breakout to the upside above 140? That would take the 10-year yield below 150 essentially, and would indicate sort of a all is well growth trade, is plenty of upside potential there. But if TLT continues to fail, is unable to break above 140, retest the lower end, or even breaks below some of these previous support levels, that would be the fuel for the next leg down in the growth story, and certainly indicate more of an opportunity for some of the value-oriented space, especially financials that have taken a bit of a pause this week. That's our market recap for today, touching on some of the key themes that we're seeing, reviewing the charts of the day. We'll take a break, come back with Katie Stockton. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we focus on the markets themselves through the lens of technical analysis, behavioral finance, investor psychology, all of that good stuff. As a reminder, we're here to help you along your own journey of analyzing charts. Shoot us an email with questions that are coming up in your own process, and we'll hope to get to it in our next mailbag segment, which will be on Friday's show. Our email is thefinalbar@stockcharts.com. You can also look us up on Twitter at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video that you're watching. We would love to hear from you. Hope to answer one of your questions in our next mailbag segment. Also, the new StockCharts TV on demand is live and ready for you, featuring all of our fantastic shows, our very knowledgeable hosts, and wonderful guests like Katie Stockton and many others. Go to StockChartsTV.com, use your email to set up a free account and start watching our content immediately. We are also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest back to the show today, Katie Stockton from Fairlead Strategies, joining us from the far East Coast, the other end of the country. Katie, welcome back to the show.
Thanks so much, Dave. I'm glad to be with you. There's a lot to talk about this week.
So there are times doing the show when I find you're struggling a bit to look for opportunities for content. I don't think that is our situation right now. There's a lot moving and a lot happening. Now, start us with gold. A lot of people, there's been a lot of focus on, precious metals really recovering. Gold had been a difficult trade for a while, but now really showing signs of life. Start us there. What are you seeing?
Well, I think most importantly, we saw gold clear a long-term downtrend line drawn back to last summer's high. And that was also associated with the breakout above the 200-day moving average. It's really telling us what we already know, which is momentum has really turned the corner behind gold. Now it's turned enough that we're getting these breakouts in the gold mining stocks along with gold prices. And the targeted level would be next resistance at the previous highs that you can see on your chart there, right around 1970 per ounce. So that, of course, would be decent upside follow through for gold. But I think importantly, we're seeing this move associated with more defensive positioning in the equity market. So I think we can frame it in that context as well as something that perhaps is being paid more attention to because of the loss of momentum and relative strength in other segments of the market.
And it's interesting, a number of gold stocks certainly have bounced up, Newmont Mining and many others reporting earnings and doing just fine. Chart number two, obviously, we had this situation this week where cryptocurrencies are top of mind. They had a huge drawdown and then just an immediate recovery. How do you make sense of what's happened this week on Bitcoin?
Well, we can look at support levels, and I have a few featured here, but honestly, it's really more of a setup that we're going to look for the all clear signal to get back into Bitcoin. You can see on the chart there, it has a bit of a topping formation. You could call it a head and shoulders top if you want to look at the, sort of peak in April as the head of that pattern. And of course, the recent breakdown below the neckline of the pattern. That's now ancient history with the downside that we've seen. I think as of yesterday's low, it was off 53 or 54% from that high. So now here we are trying to find support discovery, and 42,000 is a level that was targeted in our work by the breakdown below the cloud that preceded it. And it looks like this level really just is not going to hold by the way the intermediate term gauges have rolled over. The 50% retracement level that you see is the next support. And so far, so good on that one, right around 34,000. There is a short-term oversold reading on the daily chart and the stochastics in the middle window there. And that suggests that we could see more of a rebound on today's action, or on the back of today's action, within the context of that negative short-term momentum and also weakened intermediate-term momentum. But I don't think that that will necessarily be the end of it. We want to see more of an intermediate-term turnaround, something more than what we're seeing out of the daily stochastics, perhaps an upturn in the weekly stochastics, to be more convinced that indeed Bitcoin is really finding its footing. So it's not just a level that we're going to look for, it's really a setup in the indicators. And I do think that Bitcoin, it really lends itself very well to the kind of analysis that we do, meaning, peaks and troughs as support and resistance, the cloud model that you see there, Fibonacci retracement levels. All of that contributes to, the psychology behind Bitcoin. And I really do think it's been a great read also on investor sentiment, particularly among retail investors who really are trafficking here. When we saw Bitcoin off sharply, it felt to us like an indication for the broader equity market. And we saw sort of a crack in the equity market around the same time that it broke down below that cloud-based support. So we're looking at it not only as an asset class, but also something that can give us a little bit of a read on market sentiment.
That's such an interesting point, Katie. And I totally agree with you, right? That when you think of speculation, what's a pure, an indication of just pure speculation and where there could be euphoria and panic, it's hard to find a better example potentially than, and not just Bitcoin, but some of the other digital coins as well, right? And looking for that rollover as an indication of more of a risk-off sentiment. Now, if that's the case, we only have about a minute left, Katie, but I'd love to think, on a day like today, you have technology bouncing to the upside. It sort of feels like an all clear in one day of the growth trade, like storming back to the upside. On a day like today, does this feel more like a reaction out of a relatively weak point and a time to, continue to be cautious on things like technology and communications names? Or do you see this as the beginning of a further upside and a recovery for that space?
I don't think the pullback is over yet. Now, whether it rolls over tomorrow or next week, I can't be sure of that, of course. The reason, though, I think it's going to lead to at least one more downdraft and potentially sort of a prolonged period of choppiness or sideways price action is for the reason that these weekly indicators, or the weekly MACD, the weekly stochastics, things that are really giving us a read on intermediate term momentum, they have rolled over, and that contextualizes this pullback that we've seen in a way that really hasn't been the case for previous pullbacks, at least broadly speaking. We also have some developments on the macro technical front. If you look at 10-year treasury yields as one thing, there's a weekly MACD sell signal there as well. They previously were positively correlated to the S&P 500. So there is definitely a shift underway in the charts that I think makes a lot of sense based on how far and how fast the equity market had come and the long-term overbought condition that came with with that. So there's a couple of ways to take advantage of it that's somewhat unique. I mean, small caps got relatively oversold, and believe it or not, could even outperform in a weaker tape based on some signals that we're seeing. And we also like to look for these weekly stochastic upturns, as mentioned, and we're seeing them in some unique places. As gold miners aside, the TANs, so that's the solar energy ETF, and PVW, they have those stochastic upturns, and also some biotech ETFs like XBI have these upturns. So I think there are ways to express a view, and yet it's just going to be a more difficult tape.
Katie, it's awesome to have you on. Thanks for your thoughts, and thanks for walking through some of the charts that you're looking at. Stay safe, be well. We'll talk to you again soon.
You too, Dave.
That's Katie Stockton. Katie's the founder of Fairlead Strategies. I've known Katie and followed her work for many, many years. And I don't know if you caught one of her comments, but she talked about, you sort of have the volatility of what's going on. We're in a transition period. So you look at the weekly data, right? You look at the weekly MACD and looking at some of those signals. It reminds me of like conversations with Jeff Hirsch from Stock Traders Almanac, reminding when you're thinking of the seasonal trends, focus on the weekly MACD signal. And so it's interesting. There's a consistent theme there for some of the people I respect a great deal, that during periods of transition, periods of uncertainty, periods when it feels like there's a lot of noise, take a step a little longer, look a little longer term, and look for confirmation on the next higher time frame. That's a great take from Katie Stockton. Our next segment is called The Mindful Investor. As you may or may not know, my blog on StockCharts is called The Mindful Investor, and it's is basically because of applying a lot of mindfulness techniques to investing and to life in general. And one of the things we wanted to do with this segment is to just review or reflect on some of the things, some of the tools and routines and practices that can help you become a more mindful investor. What we're going to do today is talk about the market trend model that we feature on the show pretty regularly. Most Fridays, we go through this as part of our Mindful Investor Live chart list. So I want to talk a little bit about why we have a model like this, how it's constructed, and what it's telling us right now. So why do we have a model? I think a lot of people love the idea of having a model that makes decisions for you, right? If all I need to do is teach my model what types of things I want to look at for certain stocks or anything, and then I just let it do it for me, then the pressure's off me. I don't have to worry about my own emotions or decision-making. I can just outsource it to the computer. The computer will tell me what to buy and sell. And then if something bad happens, it's not my fault. I can blame the model, right? Here's the thing, though. I think what I have found with successful investors is outsourcing all of your decision-making capacity to a model is limiting, right? It limits your own ability to make good decisions and to focus on what you actually are good at, which is looking at thinking about potential outcomes, looking at the next big thing that a model might not be prepared for, understanding how the markets may be evolving and how your model may not be appropriate for what's coming next. So for me, I've always thought of models, especially trend following models, not as an output of my process. I don't teach everything to a model and then have it tell me what stocks or ETFs to buy. I like to use the model as part of my process. Screen for stocks, use things like the scooter rankings and a trend following model I'll show you here to understand what's happening and then apply my own analytical overlay to the output of that model. That led me years ago to create a market trend model. And there are many others that I've followed over the years that have similar ideas, looking at long-term trends and how they're evolving. So the first thing I knew was to start with weekly data, similar to what Katie Stockton mentioned earlier. When in doubt, given the noise going on, focus on the weekly data and see Friday to Friday if you've seen changes in the evidence. That's why my weekly model updates every Friday. We really try not to look at it until Friday at the close because that confirms the new update for the data. And then everything that happens between Friday and Friday is just noise. That's not something that's baked into it. That is one of the keys of being a more mindful investor, is not getting caught up in what I call the flickering ticks, the short-term moment-to-moment movements in these different prices. It's focusing on how the trends are evolving over time. So weekly data is the reason why we do that. There's a reason why I try to just look at this. I look at it every day, but I don't really change the indications until Friday at the close. It has three components: a long-term component, a medium-term, and a short-term component. I've had some questions recently about what all is input. So here you go. The long-term component, which is here in purple, is a histogram, and it's the difference between the 21 and 34-week exponential moving averages. Those are the blue and red lines that you see on the top. And very simply, When the 21 crosses up through the 34, the model turns bullish. When the 21 turns down through the 34, the model turns bearish, and that's it. It is not meant to anticipate turns, meaning it won't turn negative until the markets have really sold off, and it won't turn back positive until the markets have very much recovered. The point of this part of the model is to just keep you into the longer term trends and remember more of the secular trend, right? If I'm thinking of market movements now and I'm thinking of fluctuations, I have to remember that since last June, after a couple months after the March 2020 low, the long-term trend has been positive and it remains very positive. So I have to remember that any sort of pullback now is within the context of a secular bull market phase. The medium-term model for me is really the model that tells me whether to be risk on or risk off, or suggests that. When the weekly MACD, and this is using the weekly PPO, which is very similar to the MACD indicator, and very simply, it's using the traditional buy and sell signals. When this gives a buy signal, that tells me to be risk on and to be looking for new long ideas. When the model turns south and turns negative, it tells me to stop looking for new long ideas. And again, in general, you're focusing on looking for new stock ideas when the trends are positive overall. Now, there are always opportunities where something's going to work. And Tom Dorsey, who wrote some great books on point figure analysis, which is really driven by offense versus defense, he said, look, when your defense is on the field, there's still an opportunity. You can score a touchdown. It's much more likely that you're going to do it when the offense is on the field. So this medium-term model tells you whether or not the offense is on the field or the defense is in control. And that's just a weekly MACD signal and traditional buy or sell signals. For me, the short-term indication is just the current price relative to the 5-week exponential moving average. Every Friday, are we above or below? And that gives me the tactical read. And the daily chart is really the main way that I do the short-term analysis. Those three parts that I review every Friday gives me a sense of where we're at within the trend structure. What's the long-term trend? What is the medium-term sort of risk on versus risk off trend on the timeframes that I'm usually operating on? And then in the very short term, what's the tactical trend? And by reviewing that every Friday, I get a sense of what the trends are. I try not to chase things. I try not to get too nervous. Again, it's not an emotional reaction. You're just focusing on what the model is telling you and then going from there. That's our segment, The Mindful Investor, focusing briefly on the idea of a systematic trend following model and some of the components that go into my own trend following model. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is Facebook. Looking through a lot of charts every day, I'm struck by just the simplicity of the constructive pattern within Facebook. As much as I've thought about value over growth, the end of growth, rising rates, inflation concerns, growth is dead, all of those sorts of things, I'm also struck by the fact that Facebook just has a decent chart. You take the high from September, we retested that in November, retested it again in March, finally broke above it in early April, retested that from above a couple of times. As long as that support level holds, overall, the pattern is very, very constructive. When that pattern breaks, I would get way more nervous. And that's why these pullbacks that we saw in Facebook felt like a potential failed breakout, but it hasn't failed yet. It's continued to remain strong and remain above 300, which is that key support level. That's what I'd be watching on Facebook. Chart number 2, Katie Stockton earlier mentioned biotechs, and she's absolutely right. I'm actually noticing within the same sector, within healthcare, the strength in pharmaceutical names. When I screened for 3-month highs earlier today, it's a lot of pharmaceutical stocks. It's Johnson & Johnson and a bunch of other things, Pfizer, a bunch of them that you probably know, and some that you don't in the small and mid-cap space, but they also look very similar to the IHE, which is the iShares Pharma ETF. You can see it rotating from a pullback phase to more of an accumulation phase, testing new all-time highs, and overall in a very constructive pattern. Look at the relative strength, how that's turned from underperforming to outperforming in the last month or two. Finally, the 10-year yield. Again, if you think yields are going to go higher, this is the opportunity for that to maybe follow through. We've seen the rally in yields or the sell-off in bonds that's really stabilized in the last 2 months, and overall the last 3 months really haven't gone anywhere. We've been in that 1.5 to 1.7% or 175 range on that 10-year yield. If we would move to the upside, I think you would quickly see the strength and growth that we've seen dissipate. I wouldn't be surprised if we see higher rates from here. I also would not be surprised if growth has another leg down, and I wouldn't be surprised if those two go in concert. And if so, I would also not be surprised if gold continues to do just fine. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Katie Stockton from Fairlead Strategies. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.